Well, so historically, I mean, the debt ceiling was not used for a negotiating tool for most of its life. Ever since the global financial crisis, it started to be used more. We have a fairly small sample size of presidents since then, and most of those president terms have been Democratic presidents. And so it's mostly a tool that Republicans use against Democratic presidents. We didn't really see Democrats use it against Trump in his first term, and now we might see Republicans use it against Trump. But to answer your question, my base case would be to see not very long because of the fact that it's all intra-party, and he's got a very strong position within his party, kind of culturally, and in terms of allies. So if this were to go on, kind of as the 2023 debt ceiling did, and then I believe the 2021 debt ceiling, it could potentially go 5 months or so, kind of be a dominant factor for much of the first half of the year, and drain that 600 billion plus back into the system over the course of the better part of half a year. That's basically, if you leave it as it is now, no ability to lift the debt ceiling, ongoing disputes, and then they have an 11th hour fix to it like they've done prior. That's kind of what would happen. But I expect it to get handled more quickly than that because of the fact that it's all intra-party. So it's something that I don't think all that liquidity is going to get drained in the system, but until we see progress on the debt ceiling, the TGA will start, gradually draining back in. It is, yes. So if you back up a little bit, back in 2022, that was a very negative liquidity year. The Fed was draining liquidity, and also the Treasury was not really providing liquidity. But ever since we saw the issues in 2023, partially around regional banks, but then also the rising yields and things like that, we started to see the Treasury increase its issuance of T-bills, and that allowed them to suck liquidity out of reverse repos and back into the system. And so really for about 2 years, we've seen the Treasury almost perfectly offset the Fed in terms of liquidity. So the Fed's still doing quantitative tightening, but the reverse repo facility is draining back into the system at almost exactly the same pace. And so when you kind of look at aggregate measures of domestic liquidity, it's been almost perfectly flat. It just kind of trends sideways ever since 2023. But that's got a time limit to it, which is there's only so much left in the reverse repo facility for that to happen. And the last 2 quarters, we have seen increasing amounts of kind of strain under the surface. So the repo facility was tapped in Q3, window dressing, and then it wasn't really tapped in Q4, but we saw kind of initial funding stress leading up to it. Basically, it was expensive for different institutions to get the liquidity they needed during window dressing. If we take the TGA out for a second, we probably should expect that by mid-year or so, we run into some, pretty serious liquidity constraints in the system. We'll get kind of updates probably each quarter to see what does funding stress look like. Did anyone have to tap the repo facility, the Fed's repo facility, and things like that? But yeah, most indicators show that we're kind of pretty close to the liquidity floor in banks. And the Fed's probably going to go back to, not doing quantitative tightening this year at some point, and either have a flat balance sheet for a little while or go back up to kind of gradually increasing their balance sheet, only in terms of treasuries, while probably continuing to let off mortgage-backed securities from their balance sheet. And if you bring back in the TGA for a second, that could extend the current situation a little bit if the TGA does end up draining entirely into the system. And then you'd have issues when they go back to refill it. Now, it's still not my base case that it's going to be drained, but that's more of a political question. So that kind of does throw a curveball into things for the first half of the year. But either way, by the second half of the year, we're probably going to see liquidity constraints in the system. Well, so that's another big thing I'm watching. Is he going to follow through with his duration increase? If I imagine a scenario where he's successful in that, he could try to force it. And when those liquidity issues start materializing, it could be that the Fed is the one that has to back down and end their quantitative tightening and go back to very gradual balance sheet increases and basically say we're doing this for minimum reserves in the system and market functioning and plumbing issues. They wouldn't really do it for stimulus per se, but they would do it, just maintain liquidity. That's a whole, challenge we might see between the Trump administration and Powell. with Powell's remarks about how he can't be forced to leave. During Trump's prior term, he was sometimes critical of hawkishness out of Powell. And so instead of rates, we could see a debate over liquidity, essentially, balance sheet size, and the Fed kind of offsetting some of that duration issuance. Without Fed support, the risk is that as they try to increase duration, that would suck liquidity out of the system, and that potentially threatens asset prices. And even compared to most other, all presidents care about the stock market and asset prices, but Trump especially looks at those. And so if it kind of persists long enough, you could get Trump weighing in on that. You could get interaction between the administration and the Fed. So I certainly think it's worth watching. But I think that if I back up and say, regardless of this election outcome, how it ended up going, even last year, I was saying that I think in 2025, the Fed's going to end their quantitative tightening and go back up to either neutral to upward on their balance sheet. And this changes the personalities involved when that happens and the potential paths that could happen on. But I think that's somewhat inevitable. And so that's one way that they can potentially increase duration without a major liquidity problem, is that the Fed adds a little bit of liquidity. I think so. Especially when you have a fiscal authority and a central bank go head to head, it's rarely the fiscal authority that backs down, especially given how entrenched this all is in the U.S. And how kind of the financialization of the economy and the sheer kind of entrenchment of those deficits. So I think it's partially why there's a disconnect between kind of the wealthy and the less wealthy, or the asset owners and the non-asset owners, because anyone who entered this period with a lot of assets and with a home, either that they own outright or with a fixed rate mortgage on it, they've been pretty fine throughout this entire situation. If anything, the rates give them more money, and the ongoing deficits are generally going toward Medicare, Medicaid, Social Security, defense. A lot of it is also basically an interest expense. A lot of that's flowing to the upper ends of the income spectrum as well. Whereas where that's been challenged is anyone that's younger looking to buy a home is obviously kind of pressured in that market. We see fairly low volumes across that sector. It's ongoing just sluggishness because people generally don't want to sell unless they have to, and people are kind of waiting to buy and kind of constrained from buying. And so I think that's contributing to the kind of the K-shaped economy that we see right now. And now that I kind of view it as range bound. So during the rapid increase in interest rates, this was a really powerful effect that was happening. Now I think it's kind of absorbed. We've seen, banks have kind of absorbed a lot of the initial unrealized losses they have. We have some of the really problematic ones that got cleared out, but now it's just kind of slowly being absorbed into bank capital. And then also I think the same thing's kind of happening on balance sheets around, which is that now it's kind of range bound. So it's less of a, kind of a fast hitting factor and more of this background thing that's happening. And that's also why I categorize rate changes as so relatively inconsequential compared to other things, because one, it's fiscal dominance rather than monetary dominance. So whether or not you get extra several $100 billion in deficit spending or not is a much bigger impact than a few basis points. But then also the Fed cutting the short end doesn't necessarily translate to similar moves on the long end, which is where a lot of businesses and consumers are actually borrowing from in terms of new loan origination. It also, this kind of point to the kind of ineffectuality of the Fed here, because if you just kind of back up and say the Fed's tools to manage inflation are almost entirely geared around bank lending and exchange rates, basically. So if they raise rates, the goal is to kind of slow down bank lending, make borrowing more expensive, and also to harden your currency compared to potential foreign currency, so foreigners don't pull money out of your economy. So those are kind of the two levers. But in the current era, this entire 2020s period, we never had excessive bank lending. Bank lending was not the driving factor of inflation like it was in the 70s. And instead, we had monetized fiscal deficits. And raising interest rates doesn't do anything against monetized fiscal deficits. Now, they can push back on monetizing it to some degree. But at the end of the day, if they see dysfunction in the treasury market, they always step in to fix it. And so their tools are not really geared around that. And that's why it's ultimately more of a fiscal thing. Now, the Fed can kind of indirectly tackle that by saying, well, if fiscal's running hot and is therefore contributing to inflation, we can run bank lending at below average to try to offset it. We can say, okay, if bank lending is normally at X, we can slow that down to maybe run at 70% of X. So you have a little bit sluggish bank lending and therefore slow down money creation that way. But then all you really do is shift where the driver of the economy is. You're almost kind of like unfairly slowing something down because fiscal's running hot. And so that's kind of the big challenge that they face. And it just kind of shows that the whole model doesn't work as well as it's kind of intended to when you have fiscal dominance, which is why this period is kind of just structurally, we need different ways of thinking about it compared to how we analyze markets for much of the kind of the past 40, 50 years.